Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis. Today is Friday, January 30, 2015. You're looking at a daily chart of the SPY, and what we had today, let me just move that over, what we had today was a little bit more of a retest than I anticipated. Last night I said that we could retest around a third of the rally from yesterday, and we actually did that this morning for the most part, maybe a little bit more, but in fact, let's go over to the intraday chart and let's take a look at what happened. Here's the 10-minute. Okay, you start down here and you retrace some of the rally. Maybe it was about half. Okay, and then we actually rallied all the way up to about yesterday's high, just short of yesterday's high. And then in the last hour and a half of the day, we just collapsed down. Now, all in all, that's not good. Okay, that's definitely a weak sign. But let's look at what we have. Okay, first of all, move it over again. First of all, we're still holding this trend line, right? We know from yesterday this trend line is meaningful. However, if this trend line breaks, then we're in trouble. But here's what we have. Last week, between Thursday and Friday was a market turn, and because the market was up into that period of time, it was up here, okay, we turned down. Okay, that was a daily market turn culminating late this week at a low. Okay, I thought that the market, the daily turn would culminate, the down move would culminate late this week. Well, I thought that was yesterday, actually, but it could turn out to have been, yesterday / today. We'll see, because the interesting thing is there's another turn scheduled for the 2nd of February, which is Monday, and it's always plus or minus a day. Well, we know we didn't get the turn today unless yesterday was the previous turn, and then today was another turn down, which would be the -1 day. But I'm not sold on that concept just yet. So here's what we have. If the market were to actually turn Monday plus 1 day, so Monday or Tuesday, we would see another up move. Okay, and remember, well, I'm going to talk about the dollar in a little while, but remember, if the market turns up, okay, we're now in like no man's land. Up, I think we could actually challenge and make new highs, okay? But on the downside, if we did break down through this trend line, Monday, Tuesday, something like that, and we continue down, then you're probably, if you don't hold this area, then you're probably going to have to come into this gap window area that I've been talking about for a long time now at about 191.5, give or take, right? I mean, you'll probably reach this area, but you could overshoot it a little bit. Now, that's a pretty good ways down from here, right? That's another 80 plus or minus S&P handles from where we finished today. Okay, so that's down there. That'll scare the heck out of a lot of people. Let's go over to, I'm just looking at my notes here. I want to show you a weekly chart, because let's get a bird's eye view of what's going on here, right? So basically what we have is the weekly chart is essentially rolling over. A lot of times tops are what we call rolling tops, and bottoms are V bottoms like this one. Okay, a V bottom here. Let's find, there's, I wouldn't call that a V, but that's a pretty good solid bottom. That's a V bottom, if you will. Okay, here's another bottom. The bottoms don't take nearly as long as the tops. Okay, tops, a lot of times at major tops, tend to be rolling tops. Now, that doesn't mean the market's just going to collapse from here, because the reason I wanted to bring up the weekly chart is I want to show you that you're actually coming into 50-period moving average weekly support at 196, okay, and change, but let's call it 196. So what could happen? You could go down during the week like you did here, okay, and pierce the 50-period moving average, but then recover and close the week above the 50-period moving average. So that's a possibility, okay, because this isn't going to give way so easily, right? It didn't do it here. It's not going to just give way One day it will, but it just doesn't. It doesn't happen. They don't just give up the goose in one shot usually. Well, here's a shot, and it didn't give up the goose. So could it do it on the next run? Sure, it could. But the bulls fight the bears. So while the market may continue lower, I'm pretty sure that 191.5 area would hold if we got down to that level. If we did break our blue trend line, as we'll know it now, we'll call it our blue trend line. Here's the monthly chart, and again, look where your 20-period moving average is. It's all the way down at 188.5, and I don't even have a target down that low on this move. So what I'm saying is there's still a lot of chart support in here, pretty much above the 20-period moving average. And, they're still in an uptrend here. This is still considered an uptrend, right? Even if you pull back, you pull back to this level. Okay, you pull back here and continue an uptrend. So there's nothing to say we cannot continue the uptrend. I'm just giving you both sides of the coin here, right? Hopefully it's helpful. Okay, so let me just see my notes here. Yeah, the last thing I wanted to mention is, remember, okay, this was last week. This was last Wednesday or Thursday, or maybe this was even Friday. Either way, don't forget, this was the weekly bottom. So we're still working inside of a weekly cycle bottom, which should have more strength over the longer term, meaning multi-week, than the daily cycle bottom, or daily cycle turn, I should say. And this is what we have here. We have a weekly bottom and a daily cycle turn here. So, this trend line holds, we should see more upside for another week or two before we have to worry about it again. But we'll have to, now it's show me time. The market's in that period where it's, show me the money, right? It's gotta work one way or the other beginning early this week. Okay, let's move on. Let's look at the VIX because it's tied directly to the market, and the VIX has obviously been on a pretty good uptrend this week. So where's the top of the VIX? I don't think we can get through this level here. The last highs, the last series, these 3 days here, I don't think we can get through that. Let's call it 23, 22.5 to 23. Certainly we could, but I don't think we will. My calculations say the probabilities are that we won't. So if you tie that to where the market is at our trend line and our daily cycle turn scheduled for Monday plus 1 day, it starts to line up that we should see a bounce next week. We'll have to see what happens, play it by 1 day at a time, play it by ear. All right, let's go over to the crude oil market and let's look at USO because this is a good one. Okay. So yesterday, the day before and yesterday, I told you that 43.70 was a low. I felt was a square low in crude oil, and we hit 43.58, missed it by 12 cents on the downside. So we went through the level by 12 cents, reversed up yesterday over here. This is the USO, but I'm talking about the price of crude oil, and today we had, all in all, based on the last several months, if you will, we had a monster rally, right? We haven't seen anything like this in quite a while. So, yesterday I said aggressive traders could put a stop below the low from yesterday and play the upside, and less aggressive traders would wait for the market to tell us it was putting in a bottom. Now, the only thing wrong with this day here, this is exactly what we were looking for minus one item. And the item is the volume. The volume was good, but it wasn't high. It wasn't high enough to, for example, the volume on the 15th of January was higher over here. Okay, this was higher than this. So what that tells me is it's going to have a tough time unless it can get through this level on heavier volume. It's going to have a difficult time busting through. But all in all, this was the reversal day. This could have been the start of the reversal. We'll have to see if we see follow through. And remember what I said last night. I said next week, scheduled for, at least I have a market turn for the dollar, and I believe the dollar should be going down maybe as much as 2 points. It's 95. I have it going down close to 93 early in the week. Now, if oil can pop on the dollar going down, we may see some follow through on the upside, but basically the market hit the number. We hit the number. We turned. The sentiment, I began talking about the sentiment getting as bad as I've ever seen it back in here. I said it's going to turn. I gave you the number of 43.70 in here. We hit 43.70 yesterday, and we turned. Now, if it holds, it holds. If it doesn't, it doesn't. I don't know, but this is what we were looking for. Okay, so this is like, phase one. Okay, phase one is in, at least minus the volume part. I would have loved bigger volume, but we just didn't get it. Anyway, so, this was phase one. We pretty much had it spot on by 12 cents. That's pretty darn good for a market call. I do have to say so. All right, gold. Same thing in gold. Okay, I mean, these two markets pretty much handed you on a silver platter. I hope some of you are taking advantage of this. I know some of you are because I'm getting the emails, but I hope more of you are. So here's the deal. I told you this pivot high, this gap window, and the 200 period moving average would be great support. Yesterday, we hit that support, and we bounced off of it. And what happens today? Follow through to the upside, and we took back the $30 in gold futures that we gave the other day, yesterday, okay? And that was exactly what we prescribed, right? It was the pivot high, the gap window, 200 period moving average, upsloping 20 period moving average. I mean, you can't ask for anything more than enough indicators to take a trade than those. I mean, that was a textbook trade, and look what happened today. Big day in the price of gold, up about $30, and that translates to about $3 in GLD, right? I think so. I'm just double checking that. Yeah, it was close enough. So, yeah, 259. But so that was our gold market, and that was another great call. So hopefully some of you took advantage of that one as well. I know some did because I got the emails to prove it. So let's go on to one other thing tonight. We're going to talk about the yield market, and let's look at the 10-year yield. Okay, look at this. All right, now when we talk about yield, I don't talk about them every night, but when we talk about yields, usually I bring it up because I want to show you that the bond market is telling us there's an issue, right? And that's usually some kind of bigger force. It's not just earnings in the stock market, right? That's not what the bond market is telling us. The bond market is telling us there's a bigger issue out there that we need to pay attention to. And yields are now coming into the level from May of 2013. Okay, that's where we are right now. 167.5 on the 10-year yield. That means that you get paid 1.675% for buying a 10-year bond. That's the risk-free rate for 10 years. Okay? That's ridiculous. You're coming into good support, but all in all, I mean, let's even look at a longer-term picture, if we can get it on this chart. Yeah. This is ugly, right? I mean, if you don't bounce here, you're probably going to have to come down and test this double bottom here at 138.8, or what was the exact number? 1.394. You'll come down and test that number if this doesn't hold, right? This low here is 161. If 161 doesn't hold, you come down to this double bottom. That's pretty ugly. Let's look at the TLT, which is inverse the bond market. It's the 20 and 30-year Treasury bond. And look at this move. This is just way overextended. Here's the 20-period moving average. What do I always tell you? If this gets too extended, it has to come home. It has to come closer to home. 20-period moving average is considered home base. Look what happens when we get extended from home base. We come back to home. Up here, back to home. Okay? Up here, you will come back to home. Up here, back to home. So if next week, if the dollar pulls back like I anticipated doing, does that turn the interest rate market temporarily? Does it turn or follow through with the crude market temporarily? Some other commodities temporarily? Does the bond market sell off a little bit and yields rise again, which will push the bank stocks back up a little bit if yields go back higher? We'll see what happens. These markets aren't correlated all the time, but sometimes they will move for a week or two or longer in a correlated fashion. So let's see what happens. Let's see what next week brings. It should be interesting. The volatility is here. I think it's here to stay throughout the year. And you're going to hear comments like, January was down like 3%. So you'll hear comments like, as January goes, so goes the market for the rest of the year. Comments like that. And maybe that's so, maybe it's not. But nothing's written in stone. We just take it one day at a time. We let the market tell us what to do. And let's just go back to the SPY real quick. And we'll finish on this note. We're going to let the market tell us what to do. And on the daily chart, this trend line is going to tell us what to do. If we come down and if we close below this trend line, specifically now this one, okay, if you take out this bottom, all right, you can put your money that the market's going to come down to this gap window right here. We'll see. It doesn't necessarily have to happen the next day, but if you solidly close below this trend line or these two trend lines here, market's going to come down here and it's going to find the bottom here, and then we'll see what happens from that point. Take it one day at a time. I'll keep you in the loop as much as I can. Hopefully it's helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.